If you've heard about breakout trading or breaks and retests but still get confused at the difference, this video was made just for you. Breakout trading involves entering a trade when price breaks through a significant level of support or resistance. Breakout traders aim to capitalize on the momentum generated by the breakout, expecting the price to continue moving in that same direction. A lot of breakout traders use stop orders right at the level of the anticipated break, but I wouldn't recommend that unless you have a lot of confluence backing up that directional decision. Oftentimes a breakout can fail and gets referred to as a false break. So instead, I'd recommend you to look towards some sort of price action signal like an engulfing candle to take your entry. In this example, we've got a strong bullish move pre-session that leads up to a bit of consolidation right as New York session opens. So as this session opens, let's go ahead and play price forward a few candles to see if there's any opportunities for a breakout trade. So this first candle breaks the consolidation zone, but ends up not closing below it. So this isn't what I would consider an engulfing candle, and it's not what I'm looking for as an entry. Okay, let's keep playing price forward to see if we get another chance. So as you can see here, we break out of the top of the consolidation range and we engulf the previous candle. So that is what I would consider a good entry signal. We can place our stop loss below the bottom of the consolidation zone, and we can target a 1R or a 1.5R pretty comfortably. All right, let's keep playing price forward and see what happens. And as you can see, price consolidates a little bit before ultimately paying us. Now let's talk breaks and retests. Retest traders generally don't trade the breakout itself, but instead use it as an early alert that their trade is likely coming up. A retest is when price returns to the level it just broke before continuing the initial breakout's momentum. Many traders use limit orders at the expected retest level, but sometimes price will run right through it, causing an instant stop loss. Similar to breakouts in this regard, I'd highly recommend waiting until some sort of price action confirmation signal, such as an engulfing candle, to take your entry. Let's expand on that example from before. I've rewound time to the actual breakout candle here to show that this now creates our bias for going long since it was an engulfing candle. And instead of just entering right here at this engulfing candle, what I'm going to do is drag out this consolidation zone. And now what I want to do is wait for price to return to the consolidation zone and engulf out of it before I take my entry. So let's go ahead and play price forward and see when that happens. So as you can see, price came back to the consolidation zone pretty quickly, and this engulfing candle showed up, giving us a strong entry signal. So we can go ahead and place the engulfing candle there. We'll put the stop loss at the bottom of the pullback instead of the bottom of the zone like we did with the breakout. And now once again, we'll go ahead and target 1.5. We'll drag this out and see where price brings us. So you can see that once price pulls back into this range, this new low should be protected. So by having the stop loss below it, and you could even include a couple of extra pips for the spread, which would increase our 1.5 to up there, you'll see that this is still a pretty reliable trade setup. Hopefully this was able to showcase that breakout traders and retest traders are trading the same trade idea, but just using slightly different execution to do so. I think it's worth noting that neither style is strictly better than the other. It mostly just comes down to preference, because both styles have advantages and disadvantages. For example, breakout traders are susceptible to market manipulation through false breaks, but also have the potential to catch nearly all of the big move in one direction. Retest traders, on the other hand, can find themselves getting left behind on strong impulsive moves that never pull back to their entry, but they also have the potential to capitalize on much smaller stop losses and therefore more favorable risk to reward scenarios. But we'll learn more about stop losses in another video.